Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel for our final live class of the day, Building the Stock Portfolio. I'm your host, Kevin Horner. Thanks for being here and joining me. It's been a couple of weeks since we've convened here as I was out last week. So big thanks to Connie helping me out. And speaking of Connie, I've got Connie joining me in the chat today. So say hey to Connie today. She'll get to comments and questions that I might be unable to, but you know I keep an eye on things. I like to hear from you and like to address questions live and in the moment, so please feel free to post in the chat. For the duration of our show, we'll go about 45 minutes in total. If you're not already doing so, you are welcome to follow Connie and me on X, Connie Hill CS and Kevin Horner CS, a great spot to find us when we're not hosting classes or chats for you here on the channel. And you can also find me on LinkedIn as well. So now today, I'll give you a little bit of a heads up. Since we've been gone for 2 weeks, or at least I missed last week, we are going to review some of those positions that we were holding 2 weeks back. We've been stopped out of a couple of those, so we need to evaluate those briefly. We won't dawdle on those positions we're no longer in, but we are going to look at our example portfolio and make sure that we adjust stops along the way for positions moving in our favor and look to establish new ones. So with that, we're going to check out our disclosures first and then get to a very brief market review. So please remember that everything we cover here for you today should be considered informational and educational only. We're not making any recommendations, and we are utilizing technical analysis to review the areas of the market. But as we do that, just remember that technical analysis is simply one of your decision-making puzzle pieces, not the entirety of them. So make sure you're basing decisions off more than just technical analysis in your trades. Now, we will jump in directly to the Think or Swim desktop application here. So let me bring that up and let's put in our S&P 500. We did have a nice green candle at the close, hopefully establishing a level of potential short-run support in here, albeit you'd be well within your rights to be a little uncomfortable in the SPX, being that we are now 4 days consecutively below the 50-day and 20-day moving averages. That's not ideal from a trend management standpoint, but the truth is we've not made short-term lows. So you might fall back into a quick review and look at that, where I drew the lows of the day, the last 4 sessions. Each time we've come down there, we've seen bounces, and let's see if that maintains. Certainly a trader on the long side as it relates to the SPX probably feels a little uncomfortable under that white line. They might choose to get defensive under the white line. We'll see if that matters as we go forward here a little bit. As always, it's important that we individually define what steps we will take if the market does something different. So in the instance of the SPX here, in some cases, a trader who sees the SPX trading under 73.80 might choose to take steps to be more comfortable, which might mean building cash, having fewer dollars invested. All right, let's look at the NDX, the NASDAQ 100. A couple of things that stand out to me. That's a lower low, everybody. The good news is that lower low is encroaching on our 200-day moving average, which may end up being an area that we may need to test. As we trade this way, the things that stand out on this chart for me are the 20-day crossing the 50-day to the downside. So we've got a negative bearish crossover in the shorter term here with that 20-day. And it also might give traders a belief that any bounce we get could run into the 20-day as former support, now potential resistance. And so let's monitor that. That could be an initial area where any bounces could lose their steam. Now, today's candle is a little bit notable, right? I'm going to put an arrow right next to it just so we can highlight it. But there's a bit of buying down there at the low today, but we really can't take too much from that just yet. It didn't flip from red to green, which would be a bit of a more positive signal here. We didn't get that. So what are we looking for? We need to determine, is today's low the lowest low in any pullback in the NDX. It's too early to know, but the first thing we might look for would be a move that tomorrow closed above the high of today. And if we did that, well, then maybe we have a short-term low in, but obviously that means this time tomorrow, is there a candle that is closing above today's intraday high? So ultimately, what are we looking for? 27,927 or above on the NDX. That was today's intraday high. If we close above that tomorrow, we might be looking at a short-term potential bounce. And then our small caps with the Russell got an interesting candle. Now, today's action here, that candle stands out a lot differently for a multitude of reasons. The first is it's at the 50-day moving average, an area previously deemed to be support. Now that we're on it, we traded below. We basically traded to the lowest low we've seen since we were back here in mid-June. So the lowest low we've had in a month. And instead of it closing in the red, it closed in the green. We flipped it over. That is a hammer candle at support. That is a positive today. That's one that we can take away from the big three. Although we don't know what's coming tomorrow, but we can say that at least today, that looks more bullish than what we got in the NASDAQ specifically. And of course, why is that? It's tied to allocations. NDX heavy on NASDAQ. Russell has big components that are tied to financials, and financials have been doing quite well. So as always, don't forget to get back to your visual tabs. And if you need to, this can be a great reminder of where is the strength in individual groupings. Russell, healthcare, financials, so healthcare in the upper left corner, financials in the lower left, and then industrials in the middle here. Those are really your big three. And yes, it's got technology components, of course, but when you've got leadership from two of your other groups, if not three, you know what happens with tech has a far lesser bearing on the Russell than it does in the NDX and the SPX respectively. So hope that's a good reminder for you all. Yeah, lots of interesting moves today. I agree, Zinc. Tomorrow being the FOMC day, it's a big day. There's I think Citron put out a report expecting a surprise Fed hike. Obviously, that would be likely a bearish scenario for our broad markets. So that'll be a really good reason to keep it tuned to the channel here and to the network, which is of course a wholly owned subsidiary, third party group of the Charles Schwab Media Group. So if you're utilizing that, keep your ears to the rail on that one tomorrow. Now, all right, let us talk about some of those recent trades that we got taken out of, those recent example trades. We're going into our monitor tab. Let's go to the account statement so that we can look back on execution. So we're going to check out trade history in the last 14 days. So I'm just going to change that from 7 to 14. And here are the trades we've made since we last spoke. So 2 weeks ago, we established a position in KHC, and so far we've been able to maintain it, but we've been stopped out of our Marvel trade, our EW trade, our MS, and our Dell. So let's quickly look at those just to see how they have fared. So we were in at 410 just about, and out, unfortunately, at 380. So we got stopped out. We did an inappropriate level, apparently, because we got stopped out on a day that it bounced off of the 50-day moving average. So I believe we built our exit strategy here on the 20-day moving average and 1 ATR beneath it because we had recaptured the 20. So the takeaway here is to perhaps be a willing trader to take on a greater amount of risk to a level that we probably should have considered. Now, even if we worked with that 50-day instead of the 20, today we may have been stopped out. Look at the tail on that one today, everybody. That's a pretty significant move in Dell today, opening so darn low and then closed above the 50-day. Bulls really defended the position at this level today. So you're looking now still on Dell, a close below the 50-day would be the significant development. Let's take a look at Edwards. Edwards was a trade that we did okay on because we had bought 100 at 78.61. We unloaded half up here at resistance at 87. And then we got stopped out at the remainder at 86.51 because we had ridden this one up higher and then used the 20-day moving average and ATR beneath it to set our stop. Turns out we could have just sold all of them at all 100 at 87 and we would have been fine. We did not. We also could have sold our 50 into strength if we wanted to. We may have done better if we had done that, but you all know that's hindsight. That doesn't help anybody. So the real conversation comes in following the sale of 50 and the maintaining of our stop order. It would have been prudent for us to at least consider, should we be looking to sell any of our shares that we held for additional upside? We could have talked about that. We did not. Thankfully, in this case, while we got stopped out and profited. So we profited the majority on this trade, but we really didn't hurt ourselves by sticking with it, did we? We gave up 50 cents on 50 shares. So by no means a terrible negative. That was the difference of 25 bucks. So not bad at all. All right, next up, Marvell. This one just ended up being a dog. This example did not maintain, could not have been more poorly timed as the sell-off in tech has hit this one hard. We are in the midst of a short-term downtrend. You've got a 20-day crossing the 50 to the downside here. Kind of looks a little bit like the NASDAQ right now, doesn't it? With a new short-term low. Could we be finding support at prior highs, prior resistance, now potential support? Okay, but are we also potentially grasping at straws? Yes, we are. So as always, if you're thinking about this stuff, you have the opportunity to exit portionally into weakness. If you don't like what's happening, one, you don't have to stick with anything, the full position. Two, you don't have to hold the full position, right? You can sell off a little bit at a time. And sometimes selling into that weakness is a bit of a comfort building process. One other interesting note on this chart, everybody. Oh, that's not a tail. I'm sorry. That's when we sold out. So I thought I was looking at like we had a high trade that was into the 20-day there and failed. Turns out that's our exit trade. So no, I was incorrect. Sorry about that. Okay, what else do we have? That last trade on that was in, Morgan Stanley. Man, that's a bummer because I know that the financials were doing well. We had 40 in at 190.67. We sold 10 up here, and then we had our stop in. So we sold the biggest chunk at 209.82, and we did that on, this day again. So once more, what did we learn? We learned that the 20-day moving average, once violated evidently, it was violated back here, right? And then we got back above it. We used the 20-day. If these moving averages are close enough, perhaps what we're learning is that it may behoove us to be a little bit more comfortable with risk and give this a little more wiggle room. Again, it's not to suggest that we won't be stopped out if we had done that anyway, but I feel like we could have done a better job, so we'll see how that changes our thought process moving forward. Nonetheless, 40 shares bought at 190 and change, 10 of which sold at 215 for profit, 210, almost 210 on the remaining 30. That's still a good trade, everybody. I feel happy that this went well for us. This is what we're trying to do. We're trying to enter stocks at prices that appear as though they're going to be higher in the future, and we're running with the trend for as long as we can. We want to get stopped out when things change, when things break. you know what? It's not great that this is below the 50-day today, even though it had a little bit of a bounce in an area that could be support. So we'll see how that goes forward. But let's talk about our example portfolio today, the ones we did maintain, and let's see where we can make changes to it, okay? Let's go into here, go back to our activities, and I'm going to go ahead and make this really easy on us. So I'm just going to load a new watch list and put in the current account positions. There we go. All right, so let's talk about Zebra. We took Zebra recently. This is a downtrend break we stepped into based on the break of the downtrend. So let's see, we bought it on the breakout here. So we had to fail above the 200-day moving average 3 times, and then we broke out. And so we bought it on day 1 of the breakout essentially. And now we have our stop well below us. We are working with a 20-day currently, but I think maybe we need to make some changes here. So looking at some of the conversation going on here real briefly, just want to see if there's any questions I need to address. Okay. Yeah, Alejandra, good question. Is there a specific reason why we are using the simple moving average of the 20-day instead of the EMA? And what is the reason for the preference of using the 20, the 50, the 200? Good question. So in my case, Alejandra, what I tend to do is lean into the moving averages that are most consistently relied upon by majority of the market, if you will. 20-day representing a 1-month window. Many traders fall into the same area, which is to say that they learn technical analysis through a lot of the same processes. And following these standard moving averages or simple moving averages are easier for most of us. One of the reasons is that every calculation in the mathematics there is the same. So when we look at the 20-day moving average, it's applies the closing price of the last 20 days, adds them all up, divides by 20. And the same thing is done with the EMA, but it adds a heavier weighting to your most recent price action. So you can get faster signals sometimes, but you can also get less reliable signals. The answer to your question as to why we do it this way, simplicity. And one of the reminders that I like to bring is that technical analysis carries something that we call self-fulfillment, which is to say that a lot of these details of technical analysis are borne out to a certain extent because so many technicians rely on the same data and the same processes, if you will. So what I see in a chart is something that a lot of other traders are seeing in a chart. We individually should absolutely get comfortable with an approach that is consistent for our tolerance, our comfort for trading. But I think if you're learning and just building out your foundations of technical analysis, there is nothing wrong with staying simple and starting with a 20, a 50, and a 200-day simple moving average, very consistently utilized by many market participants. Now, with this position today in Zebra, the stock is moving in our favor. We today have learned that we need to be a little bit more risk tolerant if we are wanting to stay with our position all the while. So we're going to use the 50-day simple moving average now on Zebra to make our calculations and raise our stop order. So reminder that we use 1 ATR beneath the moving average of our choosing. Today it's going to be the 50-day, but that's not the only option. Okay. Some traders would build it against the 20-day given, I mean, my goodness, what a gorgeous candle today. Let's be honest. Tremendous candle day. The real question is, how much risk are you willing to give up, everybody? That's ultimately what we're talking about here. If you use the 20-day to exit, you're going to be giving up less of your existing profits in this trade. If we use the 200, well, then we may not make an adjustment all that much, and we are looking at an exit that currently would be at a loss. And there's no guarantee that that's what we want, right? So you have to be thoughtful about what it is you're trying to do. Some traders would look at today's action and say, yeah, I'm in at 263. It's up 20 points. Why don't I now sell 5 shares, pat myself on the back, raise a stop order up? There are many ways to go about this, everybody. But again, how you manage it is your call. Let's go ahead and build it out using the 252.23, which again is the 50-day moving average, less the amount of our ATR. Today, that's $10.71. And that gives us 241.52. And that's the amount that I need to raise this stop order up to. So let's go ahead. I'm going to right click, cancel replace, and just change the values. So 241.52. One other reminder, we're using not round numbers, right? No zeros and no fives. We like to get off of that and use an odd number, even though a 2 is not an odd number. So keeping it good till canceled, raising our stop to 241.52. It still doesn't put us in profit on an exit, right? But this is the beginning of a broader, longer trend, hopefully. And the reason I say that, everyone, I'll just remind you, big move. We've just gotten out of a downtrend. So this is us potentially catching a stock in the beginning phases of a new uptrend, which is how it came to us in the first place. All right, so we've done what we needed to do on that one. We've elevated our stop a little bit. Here's, by the way, how it looks on the weekly chart. Notice there's a lot of long-range support down here. And although I drew in that line from this last peak, you could probably activate that trend line all the way up to the last peak up here and see that it broke a very long-term trend line, everybody. So this could be a position that continues in our favor, and we may have done a nice little entry here. It would be great if we could get one of these positions to manage throughout multiple months. Would be really, really wonderful for us. So let's see how that one goes. Okay, next up, RSG recently added. Similar situation, although here, I'm going to pull these off a little bit. Let's zoom into what we see in RSG. Here we have bought in on our breakout, and we did move higher, but notice didn't hold the 20, but it has held the 200. So our stop built below the 20 is where we reside today. 1 ATR beneath the 20-day moving average. Now, thankfully, the 20-day moving average has continued higher. And yes, this is a tricky spot because we are not all that much below the 200-day, and the 200-day could easily be tested. Now, some of us are going to wonder about, should we alter this stop? And you've heard me say it a number of times. I don't like the idea of taking a stop order lower because it takes away all the work we did when we built the trade. We don't want to suggest that the work we did initially was bad. So we can keep our stop where it's at. We can also alter it to make a second layer. So instead of holding all 40 at the existing stop, why don't we just make an adjustment, say to make this 20 shares instead of 40, okay? And then, so at this price, so we'll make sure we still exit at the exact same place, okay, but for half. And then let's do the math under the 50-day. So now we are increasing risk a little bit, but we're doing it in a layered approach. And I can justify it because I don't want to exit unless the 50-day is violated to the downside. You know, if we closed below the 50-day, this is going to look a lot worse. We don't want to be in that. But let's use the 50-day and the ATR, or alternatively, traders, you could use the 200-day and the ATR if it takes you below the 50-day by a comfortable amount. So the 200 is currently at 214.63 and the ATR is 485. So that means that your exit here would be under 210, right? So lower than 210, that'd be about 250 under the 50-day. That's one option. Or you just use the 50-day and go below it by 485. Take your pick. We're going to use the 50-day and do the math. So 212.46 less our 485 gives us a stop at 207.61. So I'm going to right click, sell. And I need to edit this. So we'll edit, make that 20 shares, good till canceled at a new stop of 207.61. And I'll remind us, these stops are trigger prices, everybody. Remember, once triggered, it becomes a market order, and we can't guarantee a price of any kind. This value is assuming execution at our stop, and we can't guarantee that, okay? So especially in a gap risk situation where it trades below our stop level on the open, we have more risk to worry about. But we're working nonetheless to try and maintain the position. So by splitting this up, this is going to give us a little bit more opportunity potentially, all the while saving us a little bit on half of the position if we do get stopped out. Okay, next up is Kraft Heinz, which we just got into. We did a 200 share buy and we split our exit strategies. So we bought on the breakout and the building of a bit of a bull flag in here. And we've got an exit on 100 shares at 28. So if it rallies up to 28, we're going to sell 100. We got close there today. Our high today was 27.66. So not terrible. In fact, that's really a great move. Today looks like a bit of a breakaway, doesn't it? So we had a bit of a consolidation through here. Come on, give me that line. There we go. So this was like a little bit of a consolidation. And then most recently, this looks like a bit of a bull flag, like so. And that's what we violated with today's breakout. So we got a chance that maybe tomorrow we see a sell at 28, which would be wonderful. Now we have two stops in here, and we need to raise these stops because our price has gone in our favor. So because we are now running here against the 20-day moving average, I think this is one of those instances where notice the discrepancy between the 20 up here and the 50 down here. There is about $1.18 or so, $1.20. It's widening though. Okay, so some traders would say, let's go ahead and put an exit at 1 ATR beneath the 20 for all of it. And then other traders would say, go ahead and split it, Kev, do 100, 1 ATR beneath the 20 and 100, 1 ATR beneath the 50, or even 1 ATR beneath the 200. That's one way that some traders would look at that. So give thought. It's your choice, of course. The reason we have two stops in is because we did two separate purchases at the same price, because I wanted to ensure that if I sold some, I was still protected while waiting to come back and convene with all of you. So this way, if we do get taken out on 100, I have a stop remaining on 100 as well. So let's go ahead and do the 20-day here, 25.43 minus the ATR of 73 cents. And that pushes up to 24.70. So remember, you don't have to right click. You can just click and drag it. So I'm just going to click and drag it up to 24.69. That'll work. 24.68, just as good. Little 2 pennies below the math I did. And then let's go ahead and do the same thing here. 24.68, 69. All right. So there we go. We have protected, to the best of our abilities at least, protected the position here in Kraft Heinz that is going in our favor. And then our shining star in this portfolio of late has been Dollar Tree, which has done pretty well for us. We are in at 109.96. We've managed to maintain improving conditions here. We've got a 50 crossing a 200 to the upside, which we do enjoy seeing. So maybe we've got a new trend development to monitor here, but that's a positive. When you get the 50 crossing the 200 to the upside, we call that the golden cross. And I find the low we just made to be notable as well. Yet the low from 4 days ago happened to coincide with the prior resistance. Remember, as always, prior resistance can become new support. And it looks like that's what happened here. And our stop on this, we're at 114.71. I'm going to admit, a little uncomfortable with the stop level here, everybody. And that's just because we've seen us recapture the 20-day and then not hold the 20-day as a new trending moving average. So a little dubious as to whether we can maintain it here, everybody, but we don't want to reduce our stop necessarily. So we did do that on that RSG trade. Let's go with Dollar Tree. Let's keep it where it's at. We have an exit above us, so we have a target at 135. The highest we have traded in here since, by the way, was 133.26. So not terrible. We've done pretty well. Would have been great if we had caught that in the moment and said, boy, I don't know if that 133 and change is going to hold. Let's go ahead and sell some up there. But nonetheless, this is an improving development over the last 3 days, even though today's candle is a little uninspiring, I would suggest. Okay. Oh, we have a survey. Great. Always appreciate hearing from you, everybody. Your input is valuable. If you click that survey, you can take 2 minutes just to answer a couple of questions. If you'd like to leave comments, feel free to do so. Everything you say in those surveys come to us hosts directly. So I would be happy to hear from you there, everybody. Let's see. Is it normal to have a gap during the day? Yes, as Connie points out, it is possible to have a gap during the day. However, at the same time, it is unlikely. The majority of gaps you will find on an overnight basis, commonly, as Connie pointed out, due to news. And news is most often digested like that on an after hours pre-market basis. So earnings in the morning ahead of the market open will impact the opening price. Can be very big difference between the prior day close, both above and below. But in order for that gap to happen in an intra-period scenario, the most common situation I would say would be one where news was pending, and that pending news resulted in a halt on the stock where all trading was ceased for a period of time until the news breaks and then reconvenes. That is when you're more likely going to see a gap situation intra-period. So it's much less likely that we see that, but still a possibility. Okay, what do you say that we take a minute and review some of those leading sectors? We have position in industrials, a position in staples, in technology, and another staples. Oh, I need to move that. That's what. Oh, because I don't have it in the right portfolio. So I'm just going to move this to my building a stock portfolio class. There we go. And so now it's part of staples. Some of those groups, everybody, that I think bear watching are like, let's see. Well, there's discretionary, staples, and healthcare. So healthcare is an interesting one. As you can see, we just moved to new highs. That's a 52-week high in healthcare after a little bit of time digestion following a great rally. So I think healthcare is an area that we need to look at. So we're going to take that current watch list, current account watch list, go back to personals and find my uptrending all time frames healthcare list. Remember, this is a dynamic list. And so at least it's supposed to be dynamic, everybody. Give me just a quick second. Looks like we need to go back. So there should be a list in here right now. It's not working. So let's go to my scan. We're going to go to load that scan. So as a reminder of what we do here, everybody, We keep it simple, okay? We are only looking for stocks that are, in this case, part of the S&P 500 in the healthcare sector that are trading above all three, the 20, the 50, and the 200-day moving average. I've also required that the volume is at least 500,000 shares. That might not be necessary, by the way, if you're scanning in the S&P 500. Don't forget, the S&P 500 is 501 individual equities. They are actively traded for a reason. So you may not need that. If you get outside of the S&P 500 scanning within healthcare, it could be helpful. Let's hit the scan button. Wow, 32 companies. So that should mean if I do I'm going to just resave this scan as uptrending all time frames. And then let's eliminate this gadget and reload it. I think now we'll get that watch list to launch for us. There we go. There it is. All right. So let's look at this. What's hot today, percentage wise, IQV, breakaway gap. I mean, we could trade that, but that's 52-week highs. That might have some legs. But I think what we would prefer would be to find something that's already been in consolidation. Man, I wish we would have talked yesterday. This would have been an ideal scenario. Obviously, hindsight is always 2020, but as you can see, this was nicely consolidating for about 3 weeks after moving aggressively to the upside, holding the 20-day. That's a nice little setup that has now been realized. In fact, let's flip that over. Let's change that percent change, and let's look at the ones that are not moving today. So here's J&J set up at resistance. So that could be a breakout potential buy. So like a buy stop order, for example. Nice thing on this chart once more, just basic stuff, everybody. Remember, former resistance, potential new support, 50-day moving average is caught up with that area as well. A little bit of a range, 246 up to 270. So about a $24, $25 range there. All right, let's keep looking. We can't move with anything that's in a tight range like that. Merck is at highs, not at support necessarily. Similar here. Now this is looking, now DaVita's a little different, right? Now it's been on a trend, a beautiful trend, but it's dabbling with a breakout, everybody. Look at that. Now, because it's working so cleanly with its 20-day and because it's so close to the 20-day, this might be one that you could validate stepping into potentially with an one ATR beneath the 20-day, or based on what we've recently learned, maybe one ATR beneath the 50-day. But that's a good distance from where we are today, everybody. So maybe not. I'm going to put a pin in DVA. Let's see how Cardinal looks. Ah, now that's a little bit better from an entry standpoint. A couple of things here, everybody. Broken down trend. Draw that in. So we're 3 days above it. The implication might be now that we've got confidence that it can move higher, even though we might build our exit under the 50-day by the ATR. We do have a nice fish hook move in the RSI. And again, because we're only at the 20-day, not above it technically, I mean, we're right on it, it might make sense to build that trade with the 50-day. So I think Cardinal might be our winner here today, everybody. Let's just keep looking real quick and see if anything else is a little more tight to those moving averages that might give us a little better entrance scenario. This is not bad either from an example standpoint. Break that downtrend like so. Clear support down here. Yeah, this is looking bullish as well. But remember, we're trying to manage trends, right? We're trying to get ourselves into at a point where we can stick with something for as long as possible. There you go. CVS kind of looks like that type of a trade too. But I think you know what? I might actually use CVS here. So we are about 2 months above the 20-day. and the 20 and the 50 aren't terribly far. You've got 106 and 100. Yeah, let's go with the CVS here, everybody, where we could put ourselves in at say 110 and then an exit under the 20-day for maybe half of it, and then an exit under the 50-day for the other half. You know, we wouldn't want to be in the trade much longer, even if in the scenario, but scenario where it broke the 50-day. So let's do that. Let me see here. 5 minutes to go. Let's go ahead and get this one in, everybody. So we're gonna right click, do a buy custom with stop. Now we're not gonna set a target. So we'll do a buy custom with stop, and I need to remind us of our planning. So I'll bring the scratch pad back in. There you go. All right, so goal is not to exceed $1,000 of risk, and we can't exceed a $10,000 position. If we buy it at where we are, we're going to be buying it at 110 or better, which is a padded limit that closed today at 109.34, but we can't own 100 shares. Okay, so 110 will be our limit for tomorrow. Actually, let's make it good till canceled just for good measure. And then the math says that if we did go with our, we're going to go, you know what? We're going to go with the 50-day because I want to give us the best chance to stick with this position. 152 cents is the 50-day. Under that by the ATR, we're going to round it up from 259 to 260. That gives us an exit at 97.92. Now, if we buy at 110, which is going to be our padded limit, then we have risk of $12.08. And if we are comfortable losing as much as $1,000, as is stated right here, then we're going to take $1,000, divide by 12.08, and that tells us that we should not own more than 82 shares. So in all circumstances, we like to round down. So we will buy 80 in a nice round figure and put our stop at, what did we say, 97.92? I think that's what we got. Okay, 152 minus 260. Yep. 97.92. All right. Now, is that going to feel good if we get stopped out of 80 shares at 97.92? No, it's not. We're going to lose about $900 plus. That's not going to be fun. But the idea here is to try and stick with this as long as possible. And the key, you'll notice that I had that as day. Notice my button isn't even available to me because you can't have a good till canceled limit with a day only subsequent stop. Okay, so make sure everything lines up. Good till canceled. So we are going to buy at a price that does not exceed 110. If at any time tomorrow it's under 110, we'll buy our 80 shares and immediately have a subsequent stop at 97.92, which is only a trigger and will not guarantee that price. But cost is going to be about $8,800 there, everybody, for the trade. All right, so buy not to exceed 110, new stop at 97.92. Let's go ahead and get that one entered, and we are good for tomorrow. And then, if nothing else, everybody, next week we can consider the potential for profit taking in CVS if healthcare keeps running. And when I pull back on the weekly, boy, wouldn't it be great if this position of CVS took out about 112? I mean, that could be a tremendous opportunity. You get through highs that we haven't seen in a very long time. Put this on a monthly chart. Those are all-time highs, everybody. So if we find ourselves buying as this thing breaks out, we might have a momentum-based run. Now, we'll have to wait and see if that's the case, but that's one of the reasons this one stood out and may have opportunity. So we'll see how this example trade goes. All right. So everybody, we're at time. And yeah, Ricebird, thank you for bringing up the reminder. Yes, earnings coming here. We will not be able to talk about this before that, I don't think. What is the 5th? Yeah, so actually I think we're going to speak next week on the 4th, if I'm not mistaken. I think that's right. So yeah, we'll maybe have a chance to talk about this running a little bit, but we'll address it. Maybe we get a chance to set a limit for sale the subsequent day next week. So don't forget that survey, everybody. And also don't forget to follow Connie and me on X. Big thanks to Connie for managing the discussion there in the chat today. Your follow on X is appreciated. That thumbs up down below is appreciated as well. It helps us out in the replay of this. We'll get the notes done and compliance reviewed and updated to the channel ASAP for all of you. I will be back tomorrow morning. We have Trader Talk at Market Open with Brent Morris. So please join us for that. We'll discuss how things look off the open. Plenty of earnings companies to look at. And of course, tomorrow is FOMC day. So a potential for a big move tomorrow. We'll see. With that, thanks to all of you. Always appreciate you joining me today. Have a great rest of your Tuesday. And I look forward to catching up with you all again real soon.